Hey, my name's Josh. I'm a bookkeeper and I help dozens of entrepreneurs with their numbers. And today I'm coming out with the ultimate guide of categorizing transactions. I made this a slideshow so you'll be able to download it if you need the definitions for yourself. So if you like it, please like and subscribe. If you have any questions, please comment and let's just get started. Let's get the show on the road. We're starting with the chart of accounts, since this is basically what all accounting starts out with. And a chart of accounts is just a bundle of label transactions that describe how money moves in and out of your business. I kind of think of it kind of like labeling boxes inside your house, except we're labeling the accounts. And instead of boxes, is kind of like the buckets of money inside of your business. And an account is just a bundle of similar transactions. And to break it down even further, a transaction is just an exchange of value. The tricky part is that we categorize these transactions based on the context of each business. So, for example, if you're a food truck, I would categorize the food as an expense. But if you're a lawnmowing company and you don't sell food, I would categorize stuff like gas as an expense. So different expenses are categorized based on the context of your own business. Okay, for your chart of accounts, I explained it as money going in and out of an account so you can conceptualize it. But actually, sometimes in accounting, I may have to pay somebody money, but I haven't had the chance to give them money yet, or somebody owes me money, but they haven't had the chance to pay me yet. So it may be called an account receivable or account payable. So that's why in most videos, they don't say money, they say economic benefit. So, what is economic benefit? Economic benefit is just the value inside the present moment or the opportunity to be given value in the future. So instead of money, replace money in your mind with the opportunity of money in the future or the opportunity of resources inside the future. And now you'll understand completely what a chartered account is and what it does. There are two main types of transactions. There are balance sheet transactions, which consist of transactions related to assets, liabilities, or equity. And there are profit and loss transactions, which consist of transactions that are related to revenue and expenses. So there are two sides to every transaction. Either I can buy an asset or an expense with other people's money, like I can buy rent with a business credit card, or I can buy an asset or an expense with the money that I invested inside the business or with the money made from sales that the business made. Let's start with balance sheet transactions. Balance sheet transactions are a little bit hard to conceptualize if you haven't taken an intro to accounting course. And I try to break it down in a way that everybody can understand. So bear with me. Assets are anything of value that a business owns. Examples of transactions that include assets are transactions with cash, accounts receivable, which is money owed to your business, equipment, prepaid expenses, which are costs paid ahead for future use, or a building. A quick note is you can also list inventory as an asset. It's just my family business is a food truck and we sell out of our inventory pretty quickly. So 90% of the time I categorize it as cost of goods. Liabilities are money or commitments your business owes to other people. Examples of transactions that include liabilities are loans and payroll. Equity is the money invested by owners plus the profits kept inside the business. Examples of transactions that include equity are owner's pay, such as the owner cuts a check to himself or he direct deposits himself from the business. Owner's investment, which is the money that the owner personally puts inside the business. Retained earning, which is profit from the previous year that the businesses keeps to reinvest. And net income, which is the actual profit that you're making this current year. Okay, after all of those definitions, we have our visual of what a simple balance sheet looks like. We have our assets over here, which is our cash and our accounts receivable, equaling $1,500. And we have our liabilities and owner's equity. Our liabilities are the bank loan and the accounts payable, and our equity is $500 of net income. And as you can see, the bank loan and the account payable equals the cash inside the asset, They're both connected. And the equity would be the net income to the account receivable. So everything has two sides, and each transaction has two sides when it comes to the balance sheet and the profit and loss statement. There are profit and loss transactions. Profit and loss transactions consist of transactions related to revenue and expenses. So this is going to be the breakdown of the profit and loss statement. I chose a really simple model so everybody could understand. I'm going to do this before instead of after, since most of the definitions are self-explanatory. So we have our revenue on top of here. Then we subtract our cost of goods sold. Then we subtract our expenses. And then we get our profit before our taxes. Another thing to add is that the revenue and expenses is about 90% of the work we're going to do, especially the expenses. We spend most of our time categorizing those. So this is really going to be the bread and butter of a presentation. Revenue is the money you receive from clients or customers. Different names on the transactions may include sales, services, income, or just revenue. Expenses are ordinary or necessary costs for your business. So, what's an expense? For example, if my business was a food truck, food would be a necessary and ordinary expense. Also, gas and repairs and maintenance in case anything happens to my food truck. But now let's bring a lawnmowing business into the picture. They would need gas and repairs and maintenance to repair their mowers, but they may not necessarily use food as an expense because food is not needed in their day-to-day operations. So there are two types of expenses, cost of goods sold and operating expenses. The reason why I put cost of goods sold first is because it gets subtracted first in the income statement. So a cost of goods sold is the total cost to produce or purchase the products a business sells. To really break this down even further, COGS expenses are literally the materials that are directly used to produce the product or service, and it even breaks down to the hours of labor used to create the product. Operating expenses are the cost a business pays to run its day-to-day operations. Basic operating expenses are things like salary and wages, repairs and maintenance, rent, tax and licenses, accounting, advertising, interest expense, fuel, insurance, software, supplies, telephone, and travel. All right, quick intermission. Depreciation, journal entries, debits and credits, and explaining how to categorize depreciation and accumulated depreciation is falling a little bit too deep into the accounting rabbit hole. So feel free to skip and you'll still get a lot of value out of all the other slides without being too confused or too deep into the world of accounting. So we're going to do a breakdown of all the expenses. The first expense I'm going to break down is depreciation because it's kind of confusing, but I'm going to give you the gist of it so you can at least understand it. The first thing is a non-cash transaction. There is a book value and a tax value, so your depreciation rate might be different on your books versus your taxes, but the way I personally do it, whatever is on the tax form, I'll copy it for myself. And the thing to know about depreciation is that most vehicles and equipment has a useful life of about 5 years. So what you'll do, let's say if I have a food truck, for example, and it cost me $40,000 to purchase it, I'll divide it by the months of useful life, which would 5 years would equal 60 months, and it would calculate as $666.67 as monthly depreciation. And in QuickBooks, I would have to put it in as a journal entry. So what I would do, I would debit depreciation and I'll credit accumulated depreciation every month. So you're probably wondering what's a journal entry, what are debits and credits, and how does that relate to depreciation and accumulated depreciation? I'm going to try to explain the gist of it to you since I don't want to confuse you, but I'm not going to go too deep into it. And I have a couple of notes with me so I can make sure I'm articulate and clear. So a journal entry is just a manual recording of a transaction. So many journal entries are already automated since everything's connected inside the software. So When you think of a journey entry, 90% of the time it's going to be you manually entering the journal entry in. Credits or debits are used to explain the changes of the accounts involved in a particular transaction. Like the beginning, every transaction has two sides to it. For example, I can fund my truck using my business credit card, other people's money, and the liability would be a source of income, and the destination will be your truck. Or I can buy my truck with a business debit card using my money or the money from the business's sales, which would be my equity. In fact, it even breaks down into the accounting equation. Liabilities plus equity will equal assets because the liabilities and equity would be the source and the assets would be the destination. So I created this tiny little model here. So hopefully it'll help you visualize what I mean when I'm talking. So you see assets and expenses right here as the destination. And you see liabilities and owner equity as the source of the transaction, which makes sense. But what about dividends and revenue? So for equity, remember when I said it's your own money or it's the money from the business sales? So the revenue can go inside the business and turn into retained earnings. And retained earnings are a form of equity. So they increase while credited and they decrease while debited. Dividends is when an owner cuts a check to himself or when the owner pays himself. That has to be a destination because there is no way an owner can pay himself as a source. And that source has to come from either the liabilities, he can pay himself from a credit card, owner's equity, he can pay himself from his own money. Even though if I put $10,000 inside the business of my own money and I automatically take out $10,000 to give it back to me, doesn't make sense since businesses are supposed to build your money. It still can logically work out that way. Or I can take the business's sales and I can cut me a check out of the retained earnings inside the business. Okay, so now since we got that covered, I created two T accounts to give a very visual example. So let's say I decide to buy a truck with a credit card. A truck is an asset. So we will debit the asset, but we're using a credit card as a source of funding. So the credit card would be a liability and we credit liabilities. So for the truck, we shall debit the asset and we shall credit the liability since it's increasing both accounts. Let's say I went ahead and I bought that same truck, but instead of using a credit card, I use cash. The truck is still an asset, so it's going to increase while debited and decrease while credited. So this is going to stay the same. But let's say if I purchase it with my own money instead of a credit card, my cash is actually going to decrease, which would be credited. So because cash is an asset and it decreases while credited, my cash is actually going to decrease while credited in real life. And easy way to break this down is don't even focus on the T account, just focus on the transaction. What is the first thing being affected by the transaction? And is it a debit or a credit? And what's the second thing being affected, the transaction? And is it a debit and a credit? And if you add those two together, it's just going to magically happen. And as you can see, I buy truck with credit card. I owe more people money. So since this credit card is a liability and I owe more people money, the credit card is going to increase. Versus I buy a truck with my own money. I don't owe anybody money, but now my money is gone. So since my cash is an asset and a credit would decrease my cash is gone in real life, and the credit explains to me that the cash is gone in the T account too. So hopefully that would explain the gist of debits and credits without getting too deep into it because they're one of the most confusing concepts to learn in accounting. And I'm not going to try to give you the outcome of understanding and in a minute. All right, let's take this back to depreciation. We know depreciation is a non-cash expense. And since it's an expense and it's on the destination side, we are going to debit it around $667. But what's accumulated depreciation? Accumulated depreciation is a contra asset or a contra account. So a contra account decreases a specific account. So if accumulated depreciation is a contra asset, we just reverse the effect the debit or credit may bring to the regular asset, and we would know whether the credit or debit our contra asset. A quick tip to fully conceptualize contra account is just know that contra actually means opposite. So just reverse the effect. Just do the opposite, and your mind would understand what's going on. And that's going to solve the problem with you without you going into the rabbit hole of accrual accounting. So depreciation is an expense, it's a destination. So we're gonna debit it by $667. We know accumulated depreciation is a contra asset. We debit assets when we increase them, and we're gonna increase accumulated depreciation. So since we're doing the opposite now, since contra means opposite, we're actually going to credit this contra asset. So the debit for depreciation would be 667, and the accumulated depreciation would be credited by 667. So keep in mind, as long as you categorize each account correctly and you apply the debit and credit to it, you should be safe. To give you a visual representation of cost of goods sold, here is a picture I use as an example for a cost of goods sold. It's going to be the direct material. So let's say I was a contractor and I was building a fence for somebody else. The wood would be categorized as cost of goods sold. This metal sheet behind here would be categorized as cost of goods sold. This tape wouldn't be categorized as cost of goods sold since it's something that I'm using for multiple things. So I'll list it as an operating expense. But depending on how you want to categorize it, you can put your labor in there as cost of goods sold, or you can pay yourself separately as a contractor. So hopefully that clears up and like really opens your eyes to what a cost of goods sold is. Job supplies are tools that you use to execute a certain project inside your business. For example, using this tape measure, this contractor is using it to execute his project, which is building a fence. Equipment rentals is equipment that you rent in order to perform the daily activities in your business. So let's say I'm a farm and I want to rent out a tractor so I can continue operating my business. Don't confuse this with buying equipment, but it's very similar. You have salaries and wages, which is basically your workers and how much you pay them. This could also be called payroll. And if you label it payroll, I would advise that you separate your wages, your taxes, and your processing fee. And the reason why these should all be categorized differently is because it makes it easier on you to understand where your money's going inside this account. Repairs and maintenance is basically the money that you budget to repair anything inside of your business. So let's say I'm a food truck or I'm just a regular truck and my tire breaks. Rent is self-explanatory, but let's say that I'm a food truck who wants to rent out a space or a parking lot to sell my plates. I would categorize that expense as rent. Taxes and licenses could be kind of confusing depending on what type of business that you are. But if you're a contractor or if you're a food truck, and you have different permits for each place you go to, I'll put that under taxes and licenses. Or if you are a contractor, like electrician, and you need a certain license or a permit to do your work, I'll put that under taxes and licenses. Legal and professional services, that could be putting legal shield under here, depending on the context, or your lawyer, or it could also be your accountant, your bookkeeper, or your CPA to help you advance your business. Advertising. This one is pretty simple. Anything that you use in marketing, I'll put it under advertising. Sometimes as a food truck, I actually put event fees under advertising since I know that I need to pay the event fee for my business to reach more people. So it's dependent on the contents. Interest expense is just the interest that you're paying off your loans if you ever decide to borrow a loan as a business. And the principal and the interest that you're paying off is different. So that's why we categorize it as a different expense. Fuel is very self-explanatory. It's just the gas that you put inside a vehicle. But if you're a food truck owner, or if you use machinery like generators and you put gas in your car and your generator, you can decide to separate that expense or not separate that expense based on the activity, but it's a personal preference. Insurance is pretty self-explanatory. If you ever want to cover your business, you categorize that type of transaction as insurance. Dues and subscriptions. This one is kind of tricky, but it's just the subscriptions that you use to run your business. For example, if you use Canva for marketing, if you use QuickBooks to keep the bookkeeping inside your business, that could be used as a subscription. Other than that, I can't really think of any other examples, but just think of the software or subscriptions that you use for your day-to-day business. Office supplies and software. Office supplies could be like a chair, a table, a computer, a printer. You can also categorize software as in your POS system. If you're a food truck and if you use Square, that could be your office supplies and software. Travel, if you have a hotel or if you're traveling to your hotel, you'll put this under the travel expense. Telephone, usually I'll put the telephone inside the office supplies and software, but I see it on so many tax forms, they have the telephone as something separate. But you don't have to actually categorize this inside your business if you want to. What I mean by you don't have to categorize telephone inside your P&L is that you can just put the telephone expense inside office supplies. Utilities. Utilities would be something like water, electricity, or anything you use to run your building if you're renting out or you own the building for your business. Meals, it depends on the context of your business. For example, if you're a food truck, you can actually taste other people's food. And I've seen people categorize it as research and development. Or if you're a contractor and you're trying to close a deal and you're inviting your potential client out to dinner, you can categorize it as a business meal. Postage and freight, two things. If you're just going to the UPS store, I'll just categorize it as postage and freight. But if you're mailing out or shipping out a certain product to a customer, I'll actually put the postage and freight under my cost. Other miscellaneous expenses, or ask my accountant. If you're ever going through your transactions and you don't know what to label something, it's easy to put it as a miscellaneous expense, but please try to put it under office supplies or job supplies or whatever the closest category, because it's hard to tell what that expense is if it's miscellaneous. And if you're really having trouble with it, I'll just put the ask my accountant feature on it and just ask your accountant. If you are a bookkeeper, you shouldn't be putting the ask my accountant since you kind of are a professional of categorizing transactions. But if you are a business owner, just call your CPA really quick. Don't do it during tax time because they're probably very, very busy. And just ask them like, hey, what would I leave for this? I'm sure they'll give you a very professional answer. Shareholders loan. This kind of falls in line with more of like a balance sheet categorization instead of a profit and loss categorization, but I put it on here because I think you're going to need it. So basically, if you buy something like equipment or typically any current or non-current assets, like a food truck or a house, I actually categorize it as shareholders loan. And what it basically means is the business is going to pay this back to its owner, shareholders distribution. This is actually my favorite categorization because it helps me really pick out the difference between personal expenses and business expenses if you accidentally make a personal expense on your business credit card. So, for example, let's say you go to something like Dave and Buster's and you forgot to bring your regular credit card, so you just pay it with your business credit card. You can actually pluck out that expense as a shareholder distribution. And I do this all the time. If you have any questions, please just comment down on the YouTube, or if you have a better methodology or way of doing it, don't don't hesitate to text me or hit me up.